As we look at the live market boards right now during this active trading session on July 8, 2026, SMX, Security Matters PLC, is trading at exactly $14.90, marking a downward intraday move of 3.31% from its previous close. While short-term day traders scanning their mobile screens might just see another volatile microcap stock ticking red, the real story here is far more complex than a simple percentage drop. The underlying reality of this company completely upends the typical retail expectations of a rapid tech breakout. Most casual market observers look at a business focused on supply chain tracking and assume it follows the smooth upward trajectory of modern software enterprises. They expect predictable expansion, expanding gross margins, and clean balance sheets. But when you lift the hood on this specific asset, you find a starkly different corporate architecture defined by massive reverse stock splits, intense capital restructuring, and a relentless struggle to maintain institutional listing compliance on the NASDAQ. When people look for a place to put their hard-earned capital using modern online investing platforms, they often seek out high-growth tech opportunities. They see the massive returns generated by mega-cap names like NVIDIA stock, Apple stock, or Tesla stock, and hope to uncover a hidden micro-cap counterpart that could mimic those massive trajectories. The common ground among retail participants using their preferred online investment portals is the belief that unique technology automatically translates to immediate equity value. People see a press release about molecular marking or supply chain transparency and instantly think they have found the next major breakthrough. But the contrarian reality that forces an experienced investor to reevaluate is that brilliant laboratory science does not automatically create an investable corporate entity. A business can possess fascinating intellectual property while simultaneously burning through cash at a rate that continuously dilutes existing shareholders, forcing structural changes just to keep the lights on and the stock listed. To truly understand why the price sits where it does today, we have to look closely at the massive structural adjustments that occurred just weeks ago. In May and June of 2026, the company had to execute consecutive reverse stock splits to keep its share price above the regulatory minimum required by the NASDAQ. First came a heavy 20-to-1 reverse split, followed shortly by a subsequent 2.285-to-1 adjustment. If you look at the long-term charts on your preferred investing sites or pull up the historical performance on a professional interactive brokers platform, the adjusted historical high looks absurd, reaching hundreds of thousands of dollars per share. That astronomical number is not because the stock was once worth a fortune, but rather the mathematical artifact of massive share consolidation. This creates an intense tension between expectation and reality for retail buyers using a Robinhood app or tracking positions via SoFi Active Investing. They see a deflated stock price and expect an easy recovery, but the reality is that reverse splits often signal underlying capital distress and institutional selling pressure. Looking at the current trading volume during this session, the liquidity remains incredibly thin, which is typical for an asset with a microcap valuation hovering around $10 million. On any standard individual brokerage account, low volume combined with wide bid-ask spreads means that even modest buy or sell orders can cause dramatic, unpredictable daily swings. For active participants using advanced interactive brokers trading setups, this lack of depth represents a double-edged sword. While it allows for rapid price spikes on positive headlines, it also means that unexpected selling can flush the stock to new lows with almost no support. Institutional investors managing large asset allocations through Fidelity Investments or premium wealth management services completely avoid companies with this kind of volume profile because they cannot enter or exit a position without completely distorting the market price. Consequently, the asset is left almost entirely to short-term speculators and algorithmic trading programs that thrive on intraday noise. If you look across the broader sector momentum, the business services and industrial tracking space has seen significant interest due to global supply chain pressures and new environmental compliance mandates. Yet macroeconomic pressures like higher persistent interest rates have shifted the focus of major fund managers toward companies with proven positive cash flow and away from speculative technology ventures. When people utilize tools like Schwab Intelligent Portfolios or similar automated advisory systems, these models naturally steer capital away from highly volatile microcap names toward diversified vehicles like Fidelity ETFs or broad market index products. This systematic diversion of institutional capital means that companies like this one must rely almost exclusively on retail enthusiasm or specialized placement debt to survive. Comment below how many shares of SMX you currently hold, or if you prefer sticking strictly to megacaps like Apple stock in your personal portfolio. Let us look deeper into what this entity actually does to survive in this harsh financial ecosystem. Based out of Ireland, the company operates within the specialty business services industry, focusing on what they call a circularity as a service platform. Their core business model revolves around hidden molecular marking technology, where a microscopic, invisible chemical signature is embedded directly into physical raw materials, such as plastics, rubber, or even gold. The idea is to allow companies to track their products throughout the entire life cycle, verifying the authenticity of materials and proving that recycling mandates are actually being met. From an operational perspective, the concept addresses a genuine global demand, as corporations face mounting legal pressure to verify their sustainability claims. However, the operational expectation of global adoption has continuously collided with the harsh reality of long sales cycles, high implementation costs, and a lack of scalable commercial contract that can offset their massive general and administrative expenses. When we review the past financial reports, the income statements show the classic challenges of an early-stage business struggling to scale its revenue relative to its operational overhead. Research and development expenses, combined with high selling and administrative costs, have historically led to massive operating losses and deeply negative returns on equity. For anyone analyzing the fundamental metrics on a Fidelity trading platform or tracking financial health via SoFi investing dashboards, the numbers require careful scrutiny. The balance sheet has frequently required capital injections, leading to the issuance of new shares and convertible notes that put a natural lid on any sustained upward price momentum. When a company must constantly issue equity to fund basic operations, every upward move in the stock price is often met with new shares hitting the market, diluting the upside for individual brokerage accounts that bought in during previous rallies. This persistent friction between technological promise and financial execution is exactly what defines the current sentiment. Retail investors logging into their Robinhood stop trading accounts often get captivated by the sheer utility of the technology. They read about tracking supply chains or enabling a truly circular economy and expect a massive corporate adoption curve. But institutional analysts looking at the hard data through interactive brokers' fee schedules and comprehensive corporate filings see a business that is structurally fragile. This creates a clear divergence where the public narrative focuses on what the company could be 5 years from now, while the market pricing reflects the immediate risk of ongoing dilution and listing vulnerabilities. It shows how critical it is for individuals engaging in self-investing to look beyond basic headlines and understand the structural mechanics of microcap equities. Looking forward toward the final horizon of this analysis, the future outlook for the stock depends entirely on how the company manages its upcoming catalysts against its clear structural risks. The primary upside opportunity lies in the potential execution of a major revenue-generating commercial contract with a global industrial giant. If a major multinational corporation fully integrates this molecular marking system into their global production line, it would provide the predictable, recurring revenue stream needed to stabilize the balance sheet and restore institutional investor confidence. Furthermore, if international regulatory bodies pass stricter and forcible mandates on plastic recycling and material traceability, the market demand for their platform could accelerate significantly, shifting the reality closer to the optimistic expectations that retail buyers hold. Conversely, the downside risks remain prominent and cannot be ignored by anyone practicing careful online investing. The most immediate threat is the ongoing pressure to maintain compliance with the Nasdaq capital market rules. If the share price slips further or fails to sustain upward momentum, the company could face the prospect of another round of equity restructuring or potential delisting to the over-the-counter markets. A move to the over-the-counter boards drastically reduces liquidity, as many mainstream platforms like the Fidelity mobile app or standard robo-advisor accounts restrict or penalize trading in unlisted assets. This would isolate the stock even further from mainstream capital flows, leaving it vulnerable to extreme volatility. Additionally, if the burn rate continues to outpace revenue generation,